You may think Morningstar is just the place you check fund ratings, but its stock is trading significantly lower than its long-term value might suggest, and insightfulvalue.com flagged this as a potential hidden opportunity. Just to be clear, this review is for informational and educational purposes only, not financial advice. Morningstar, Inc. is a leading provider of independent investment research, data, ratings, and analytics, serving individual investors, financial advisors, and institutions. In 2024, Morningstar reported full-year revenue of $2.28 billion, up about 11.6%, and recorded a huge jump in operating income to $485 million, with an adjusted operating margin of around 21.7%. Their free cash flow also surged in 2024 to $448.9 million, more than doubling from prior years. On the value analysis side, Morningstar generates very recurring, subscription-like revenue from data, pitchbook, credit ratings, and advisory platforms, giving it strong cash flow resilience. In Q1 2025, they grew revenue by 7.2% to $581.9 million, with adjusted operating income up 22.2%. In Q2, revenue was $605.1 million, and adjusted operating margin rose to 23.7%. By Q3 2025, free cash flow remained solid at $160.1 million. When it comes to returning capital, Morningstar also buys back shares aggressively, for example, $109.6 million in Q1 2025, and pays a dividend, though its dividend payout has been quite conservative relative to its cash flow. In 2024, it paid just 15.4% of free cash flow. They have increased the dividend over recent years, but their priority has been reducing debt too. So why is the stock down or weak now? A few reasons. Morningstar's free cash flow in recent quarters has seen volatility, with Q2 2025 free cash flow falling 48.3% compared to the prior year. Operating expenses are rising, including compensation costs tied to severance. They are sunsetting Morningstar office. Also, its heavy non-US exposure means foreign currency headwinds could be weighing on earnings. On top of that, investors may be uncertain about Morningstar's M&A strategy and how they will integrate recent acquisitions. Despite the weakness, there is a strong bull case. If Morningstar continues to scale its pitchbook business, expand its data and analytics offerings, and leverage the convergence between public and private markets, especially with its AI-enhanced workflows, its cash flow could rebound strongly. Management's large share buybacks also signal confidence. On the flip side, if macro or currency pressures persist or if integrations falter, its cash flow could lag and growth could slow. So, this might be a moment to think about Morningstar as a long-term value play, or cautiously wait depending on risk appetite. For a more detailed breakdown, including valuation models, multi-year projections, and scenario analysis, check out insightfulvalue.com, where we simplify complex company data so you can make smarter decisions. If you like this kind of deep dive, please like, subscribe, and leave a comment. Do you think Morningstar is a beaten-down gem or a value trap? Thanks for watching. And don't forget to head over to insightfulvalue.com for more undervalued ideas.